Welcome everyone to the next session at the UT PhD Symposium. Today's topics are the economics and market effects of ESG and climate risk. And we have three great speakers, commentators on these issues. And I'm not going, it would take me like 15 minutes to talk about all the accomplishments of these three gentlemen. So I'm going to just briefly say that we have John Cochrane, who's a senior fellow at the Hoover Institution, a senior fellow at the Stanford Institute for Economic Policy Research, and a professor of finance and professor of economics by courtesy at Stanford. We have Anil Kashyap, who's the Stevens Distinguished Service Professor of Economics and Finance at the University of Chicago Booth School of Business. And he also works with the Bank of England. And then we have James Stock, who is the Harold Hitchings Burbank Professor of Political Economy, Faculty of Arts and Sciences at Harvard, as well as a member of the faculty at the Harvard Kennedy School. And he was a member of President Obama's Council of Economic Advisors. And I'm bringing in these other things because they have experience with both the academic world as well as the regulatory and active world. So with that, I'm going to ask Professor James Stock to start us out.
Okay, so thanks very much, Laura, and thanks, Megan, for organizing this. This is a great program. I'm really glad to be here, and it's really terrific that that there's so much interest in these issues. What I'd like to do, my expertise is actually not so much in the finance world and certainly not as much as Anil and John's. So what I'd like to do is set out some general thoughts about climate finance broadly and trying to put that in context. And I'm going to try to ask a few provocative questions, which surely Anil and John will have perfect answers to. Okay, so I'm going to just share my screen for 1 second here. And you should be seeing it, yes? Okay, good. Okay, so this is the Pyrocumulus Cloud from the Dixie Fire. You've probably seen this before. Climate change is getting worse. The IPCC report just came out. They had just a report that just came out that basically said we better get our act together here and deal with this problem. I would completely agree with that. So I think there's a huge challenge, and there's an important role for economists to play in addressing this challenge, and a critical role, I should say, for economists to play in addressing this challenge. What I'd like to do is I'd like to sort of think about what the size of that challenge is, first of all. So this is a graph of emissions in the United States. They peaked around 2005. The Paris target, which was pretty ambitious, was a 26% reduction from 2005 levels. We're not on track to make the Paris target right now. This dashed line is the projection of emissions by the Energy Information Administration made back in January under business as usual. This is what the Biden administration wants to accomplish, which is 50% by 2030. Even a straight line projection doesn't get you there. And of course, because carbon accumulates in the atmosphere, 50% at the end of the day, that might be good by 2030, but that's not enough. It's got to go to zero by 2050 or something in that range. You know, you can bicker over a specific word, but fundamentally, we're going to have to get to net zero emissions if we're going to stabilize the climate. Okay, so that's on us. How do we think about it as economists? We think about it as there's market failures. Well, obviously, there's the greenhouse gas externality. We don't price carbon emissions. We don't price methane emissions. So that's going to fall on other people. We all understand that. There are other externalities too. There's an innovation externality. So if you invent something that's going to be green and good in the future, you're not going to be able to capture. You might get a patent, but you're probably not going to capture all the value of that. And if you make some learning by doing innovation, maybe you can keep some of that information confidential for a few years, but ultimately not really. So we underinvest in innovation, generally speaking, and that's particularly true in the green area. There are network externalities. So charging stations and EVs is a perfect example of network externalities. If you're a company that's building charging stations, why would you do that if there's no EVs. If you're a person buying EVs, why would you buy EVs if there's no charging stations? And so we've got a low equilibrium. We also have a high equilibrium. There's roles for government and moving between those. There's lots of other externalities. So how do we think about that as a policy matter? I mean, the traditional policies are to think about a combination of economy-wide policies, such as carbon taxes, and sectoral policies. I've listed some here, and there's many, many more that you could go through. So these are all ways to address these different externalities. So for example, one of these, if we're going to subsidize EVs, that might be addressing aspects of it. A clean electricity standard is essentially a carbon pricing program on the power sector. So there's a variety of different policies that we could pursue. The trouble is, in the United States, at least, we're basically doing virtually none of these. And so then the question is, what can we do instead? Well, there's certainly subnational. Some states have renewable portfolio standards. Some towns are considering mandates of that there's no natural gas hookups for new buildings. Some states are doing EV subsidies. So those are definitely not, those are steps in the right direction. Maybe they're just expensive and not steps in the right direction. You can argue over that. There's lots of papers. They're certainly not economy-wide, national level policies. They're going to be super effective. And so suppose that doesn't work. You can do things on your own. You can fly less, or you can be a vegetarian. You can buy carbon offsets. And this is like, there's a lot of people who talk about that. You can do that. If you're a corporation, you can make a green pledge. You can say make a zero carbon pledge, or you can buy ESG portfolios, or you can say you can be an activist investor. So those are different things you can do on your own. What we're here to talk about in this panel, and I guess in this conference, is we're here to talk about what other things can be done within the financial sector. So there's a number of issues on the table in financial and monetary policy, financial regulation and monetary policy. Some of them are, and I've only listed some of them here. So carbon disclosures, carbon risk disclosures, climate risk disclosures. There's climate risk is both a physical risk and also transition risk, because you might have, because of unexpected policy changes or expected policy changes that might lead stranded assets and so forth. There's green bonds. The ECB is starting to support green bonds. That's an example of monetary policy that gets engaged in climate. Green infrastructure banks, and other aspects to it. So I'm going to raise a few questions here just to set this stage. First of all, I want you to remember that it's these policies, these are the ones that we really need, okay? These are the policies that are going to make a big difference. They're going to make it expensive to burn fuel. They're going to make it cheap to buy EVs. They're going to subsidize new green innovation. That cheaper innovation is what's going to make it possible for developing economies to be cheaper to be green. That's what we need to have happen. We're not doing it. So then what is the role of climate finance? Why do you do climate finance? Well, one reason is it feels good, or it's popular, or you can explain it to your friends. Another reason is that you can make money on it. I mean, maybe there's alpha if you short coal or something like that, I mean, that there actually has been over the last few years. So you can make money on green finance, or at least you were able to during that period. Maybe you can be enhancing systemic stability, so that's a good thing. Central banks are supposed to be enhancing systemic stability. That's a positive. It doesn't have anything to do with climate, but it might be a good thing to do. Or you can think about this as climate policy. Well, how can it be climate policy? Well, I think this is the interesting question. So what I'd love to do is hope that we engage in this question during this panel. And you can think about climate policy. I guess the initial reaction is monetary policy isn't climate policy. So I'm going to put out there, maybe monetary policy can be climate policy. If we're not willing to do any of this stuff, maybe monetary policy can be second best climate policy. And what does second best climate policy look like if it's done through a monetary lens? Does it mean subsidizing certain types of investments like the ECB is doing? Maybe there's, how close can that come to a first best policy? Does it mean through disclosures or through making it burdensome for fossil fuel companies, can we raise the cost of funds? Is that what we should be doing? If maybe it is what we should be doing if we're not willing to do any of the harder stuff, and we can do that through our monetary institutions. So I'm just going to leave it there. But what I'd like you to think about And I guess what I'm posing is, what's the point of all of this? Why are we doing these different things? What are we aiming to achieve? They're a virtuous thing. There's nothing wrong with feeling good. There's nothing wrong with making money. There's nothing wrong with enhancing systemic stability. Those things aren't reducing emissions. What can we do to reduce emissions here? And what is the role of the financial regulatory authority? So that's just asking questions. It's not answering any of them, but I am sure that Anil and John will either ignore what I have to say or answer all these questions.
Thank you very much. You brought up some great issues, and now I'll turn it over to Professor Anil Kashyap to tell us more.
All right. Thank you, Laura, for having us here. This is a great topic. It's very important. I'm going to try and make my comments more bite-sized. I thought Jim touched on a lot of big issues. We can see which direction we go. I want to talk about three things today, which is I think of the role of climate finance as partly just to make sure that the financial system does not amplify things and make things worse. And that's the way I want to phrase this. And I'm going to start by just asking why don't the firms just take care of these risks themselves? I'll say that they won't. I'm going to argue that there's a role for supervisory powers here, and in particular stress tests that I think can be particularly valuable. And then I'm going to toss out a few questions that are somewhat different than the ones Jim posed. And I should preface this by saying I'm just here as a professor. I'm not speaking as a member of a policy committee of the Bank of England. So the first thing is just to reiterate on the language that Jim introduced. I think a lot of the risk is not the thing that the public thinks about, which is all the physical risks, but rather the transition risks that will come because of policy choices. So imagine that we did introduce a carbon tax. I don't expect one in the United States soon, but if we did, what would you have to do to figure out how that was going to play out and what that would mean for financial institutions? Well, you'd have to think about what would happen to relative prices. You'd have to think about what offsetting technological solutions would appear. You'd have to think about consumer behavior. And then you'd have to think about general equilibrium effects coming from all the other financial institutions responding to these things. So it's a challenge to try to model any of this. And you know, it's the official policy of all the Paris signatories that something like this is going to come. So if it were to come, what would it mean? Well, there's vast disagreements about how big a deal this would be. Here's one estimate of just how dependent certain governments are on fossil fuel revenue. So if you think about what it would mean for Iraq or Oman or Qatar to see the prices of fossil fuels plummet, think about what that's going to do to their government budget constraint, and think about what that's going to do to their incentives to pump oil, for instance. So there's lots and lots of tricky stuff that you'd have to think through to understand this. The numbers are all over the place, differences of trillions and trillions of dollars about how much might be stuck in the ground if there was a rapid adjustment. So one thing that you might think is, well, the market's going to send signals. Right now, the market signals are that if you look at the value of oil extraction or natural resource extraction companies, and you look at what their enterprise value lines up to be, it sure looks like they're assuming all the proven reserves are going to get used. And that's one indicator that the market's not yet on top of this, or it doesn't believe that stuff's going to end up stranded. So why won't self-interest work? I think firms are trying to do things like this. So here I'm thinking mostly about insurance companies and banks. And what they can do is if you want to give them an assumption or a set of assumptions, they can try to calculate what that might mean for their portfolio. But if you were to ask them, you know, how do you come up with reasonable assumptions? And can you come up with a scenario that fits together where all the relative prices make sense jointly? It's incredibly expensive. That's not something that these companies are set up to do, because you have to model all those things I already pointed to, and you probably can't even get a trade group to do it. So that's one big problem. The second big problem is it's really hard for a firm to know if its competitors are well run and what they're going to do. And then finally, if you don't know what the other firms are going to do, you're not going to be able to figure out the prices. So if you were trying to say as a public policy matter, the one thing we don't want is a climate crisis turning into a financial crisis. We want to know which climate scenarios are going to bankrupt the financial institutions. You wouldn't be able to tell unless you could come up with such a scenario and then do a reverse stress test. So I think there is a strong role for supervisory stress tests. Here are some of the reasons why I think financial regulators should be getting into this. First, they can actually afford the cost of scenario development. I mean, it's a shared public good to come up with such a thing, and they can come up with one that's pretty detailed. They can then compel participation of large players so that you can aggregate the responses that these people are going to have to come up with something that would approximate what might happen to prices. You can then share the results, and you might find out that everybody is going to dump a certain sector, and the price that you built into your scenario is way too optimistic because all the firms faced with the beginnings of this scenario would all get out of some areas. And in that case, you could go ahead and say, okay, let's refine the scenario, try it again, kind of a war game where you now have seen a little bit of the hand. And ultimately, then you can figure out what are the scenarios that would actually tip over the financial system. And then you could start having a conversation about are those the ones that we're actually likely to see? And if we start down that road, what might we want to do? So I think that's a promising area for financial supervision. I'll close with 3 questions that I don't think are dissertation topics, but I think there are topics that are going to be in the air in the regulatory and public policy domain and are worth thinking about. The first one is, how can we use market prices to design and cross-check any of these stress tests? For instance, I showed you that some of these governments are going to have huge incentives to pump the oil out because their entire social structure depends on that revenue. What will that mean for prices? What do options prices show to suggest people are thinking about this? Second thing that I don't think we're going to get into here so much, but I think if you've attended the rest of the conference, you must know that there are big disparities in ESG scores. And if you look at 5 different ESG ratings, the correlations will be pretty low. How are you going to use that kind of thing to guide climate policy if we can't even agree on what's green and what's brown? And then finally, a lot of people seem to naively think that insurance companies are going to be left holding the bag, but of course their policies only last 1 year at a time. So when the insurance companies pull out of some sectors, what is going to happen? And I think it'd be interesting. We don't have good historical experience where whole asset classes just disappear from being insurable. But I think trying to figure out something more about that would be helpful. So I'll stop here and look forward to the rest of the conversation.
Thank you. We now turn next to Professor John Cochrane for his insights.
Well, hi, everybody. Since this is a PhD student conference, I'd start with a little advice. Jim Stock and I got to know each other in our first year study group. What was that, 40 years ago, Jim? Anil, I think I got to know Anil the day he walked in as an assistant professor at Booth, which must have been like 30 years ago. So be nice to your friends. You're going to know them for a long time, and they will be great resources for you as you get older. As both Jim and Anil have been to me, as well as debate partners. I think in my comments, I'll talk a little bit about climate overall, and then how climate financial regulation fits into that. And I'm going to advertise, I have a blog called The Grumpy Economist, where I have some essays that take these on in much greater detail that I won't get to talk about today. I thought I'd bring along a little, I don't have slides. I'm going to try to get through a whole 5 minutes without slides, but I hope, can you see that? Jim, nod your head if you can see that headline. This is the headline in the Wall Street Journal today. White House urges OPEC to boost oil supply. That will either teach you something about cognitive dissonance and the need to become behavioral, or it'll teach you something about the great difficulty, political as well, of climate policy. So I'm not going to argue with one line of the IPCC scientific report about weather, and we don't have to, in order to disagree with much of climate policy, because, and this is good news for you, economics is at the center of the debate. We know much less about the economics of climate change than we do about the physical science of climate change. How much does climate affect the economy? How much do various cures help and when do they help? Those are the things we don't know about, and economists can do it. The science, the planet's getting warmer, check. Some places are getting warmer than others, check. Some will rain more, some will rain others. Severe weather, fires, and thunderstorms and floods, well, maybe. That's actually low confidence in the IPCC, but we don't need to argue about it. Those things are there too. The economic impact, let's just face some uncomfortable truths. The economic impact is likely small. Even the worst case scenarios say something like 5% of GDP if we don't do anything at all, maybe 10. Adaptation in 100 years of technological progress might well bring those down. You know, think if in 1920 people were having a discussion of how to adapt the Model T for 2020 emissions. That's the kind of technical change we're going to have in the next 100 years. But 5 to 10% is couch change. This is the fundamentals hard problem. 5 to 10% is just 3 years of our current anemic growth rate. So if we don't do anything about climate change, 2100 is as bad as 2097 would otherwise be. Europe's GDP per capita is 40% less than the US, 4 to 8 times worse than climate change. US zoning laws alone cost about 15% of GDP. India's GDP is 1/30 of the US per capita. If the question is how to improve GDP by 2020, how to reduce world poverty, growth, not climate, is the answer. And there's a big question. Are we answers in search of questions, or are we trying to answer questions? Floods and fires. The sad fact is they're not that costly to GDP, and they're easy to mitigate if you have a century. Amsterdam's been underwater for 400 years. They built dikes by hand. It's not even clear that climate hurts GDP. People are moving to Texas, where you are, and it's a lot hotter there than it is in the Rust Belt. I think, in fact, it would be much more honest and much more effective to say that, like coal, soot, and pollution, this will cost GDP, but the environmental benefits are worth it. And then we could focus on the environmental benefits and not pretend that this is a growth policy. There's also a strange logic of cause and effect going on here. Let's suppose that, like Jim's slide, it is true that the Dixie Fire is due to climate change, and that having more wildfires, if it's true that we are having them, is due to carbon emissions and climate change. That does not follow that the way to fix them is to build a high-speed train. The full Green New Deal will do nothing about climate and wildfire in the next 100 years. Building the high-speed train will not reduce wildfires by 1 burnt pine cone in your great-great-grandchildren's lifetime. The goal is to limit the further increase of temperature, not bring back pre-industrial temperatures. If the question is how do we deal with the impact of wildfires, spend a little bit of money, not even trillions, to clean out the damn brush. Another uncomfortable truth of the climate models, subsidizing green energy won't budge climate. It makes energy overall cheaper and at a huge budgetary cost. Regulating away fossil fuels, making energy more expensive quickly, will destroy today's economy far more than it helps the 2100 economy, especially in poor countries. If the question is, how do you help the climate without destroying GDP? Innovation and adaptation and innovation to make clean energy cheaper without subsidies is the only option. Jim said, cheaper to be green. I love that slogan. It's the only way that's actually going to hurt. Here, economics has 2 more invaluable tools to offer. First, if the question is, how do we reduce carbon? An evenly applied carbon tax. Now that's even to the coal emissions used to make solar panels and car batteries, but an evenly applied carbon tax in place of regulation and subsidies is the only thing that's going to make a dent without destroying the economy. If the question is, how do we regulate things with faint effectiveness, we have to start even pretending to use cost-benefit analysis. If we're going to, let's read the infrastructure bill, have electric car charging stations across Nevada, tell us how much they cost, how much carbon they save, how much they lower global temperatures, and how much they improve 2100 GDP. The silence on this issue in current policy makes me very suspicious. If the question is, how do we funnel billions of green pork to political constituencies? Well, I have just the answer for you, our current policies. Now, financial regulation. There's this new fad, climate policy via financial regulation. Essentially, boiled down, central banks and regulators such as the SEC will tell financial institutions to stop funding fossil fuel companies and subsidize finance of particular green projects. Windmills, solar panels, electric cars, and rails are in. Nuclear, carbon capture, hydrogen, innovation, and zoning reform. Zoning reform, so that instead of buying electric cars, you can walk to work. No, we're not doing that. Why are we having the Fed do this? Because the democratically elected legislatures and the accountable administrations, see my headline, are not doing these things fast enough for climate advocates. Now, the trouble with this is that financial regulators have no power. They are not legally allowed to do climate policy. So we've invented a fantasy, climate risk. Now, what does climate risk mean? It doesn't mean risk to the climate. Central banks aren't allowed to regulate risks to the climate. But it means some financial risk related to climate. Now, what is that? Well, it could mean the risk that the climate will change so drastically, so abruptly in the next 5 years, that, in 5 years, because that's the horizon, we can vaguely pretend to see the stability of the financial system and the regulatory horizon. We can't regulate loans made 100 years from now. That the US economy tanks so terribly from this weather change to blow through equity, to blow through long-term debt, and to spark a crisis. There is nothing like this in the IPCC report. It's nothing in the 5 We know the climate in the next 5 years, and weather extremes just don't move the US economy that much. We've had hurricanes. They don't cause financial crisis. Well, what is climate risk? Anil mentioned the risk of stranded assets, really the only place where I disagree at all. Too bad, we were supposed to have a fight. Well, what is the risk of stranded assets? The risk that regulators will wake up and kill fossil fuels, as the Godfather might have said, nice business you got there. Too bad if we should regulate it into a financial crisis. Well, maybe regulators are that dumb that they will cause a financial crisis. But notice they just did that to coal, and the stock market's booming. Old technologies gradually fading away never cause financial crises. They're not funded by short-term debt. It's the new technologies that cause crises. The horse and buggy fading away did not cause the 1929 stock market crash. It was the new technologies. The typewriter and slide rule industries fading away didn't cause the 1999 stock market crash. It was all the new technologies. You want energy-related financial risk? Tesla, with 1,000 price to earnings ratio. There's a teetering domino. All the vastly overvalued growth stocks in the ESG portfolios. There's the financial risk, not the slow ones. And furthermore, it is not the job of the Fed to make sure that nobody ever loses money. Let's remember that. There's too much idea that the Fed, that our financial regulators are supposed to manage the whole financial system. Anil sort of alluded to this, and make sure nothing ever loses money. That's not it. Now, you may be surprised. I'm all for disclosures and regulated content and the ability to sue if these disclosures turn out to be fake. Why? Because most of the green statements made by our companies are just empty virtue signaling posturing. And if they had to document what they said about their carbon pledges under criminal liability, we would have much more honest pledges. The fact is, and as Anil pointed out, it's just really hard to compute your carbon footprint. And we don't really know what it is. If the question, and here I'll sort of agree with Anil, if the question is financial stability, suppose that's why we're doing it. Some out-of-the-box risk, like the weather might change in a way no model says it was in the next 5 years, well, then we have an answer to totally out-of-the-box risks. That answer is lots and lots of capital so that banks don't fail no matter what happens. It is not detailed regulation of the bank assets. If the question is out-of-the-box risks, we ought to be looking at nuclear wars, pandemics, civil wars, all the things that our stress testers don't look at. Remember, these stress testers are no more brilliant than the companies, which Anil said can't calculate stuff. And the same stress testers, in 10 years of figuring out what could go wrong, never thought to ask, oh, what happens if there's a pandemic? And we just had another big budget blowout. The chance of them getting it right is next to nothing. Climate risk to the financial system, justifying that financial regulators take on climate policy, tell banks where to land and who to defund, in advance of democratically elected legislatures and properly deputed my environmental agencies doing so. That's just a completely meaningless buzzword. It's an interesting sociology about central banks' echo chambers can dream up questions when they have answers they want and convince themselves of nonsense, but that's what it is.
Okay, thank you very much. Anil and Jim, would you like to respond to John's comments?
I'm gonna just, I think that one could respond to every sentence and disagree with, well, I don't know if I want to take that. Let me just make a couple of
I
points.
didn't disagree with anything you said. That
I think it's something, there is actually an important element of, there's an important element of truth in a couple of points that John made. In terms of the overall cost to the economy, I think that we have to recognize that these things are not certainly over the next sort of 50-year or 70-year horizon, which has got to be about as far as we can look out. These are not going to be super duper costs. We're not talking about financial crisis year after year after year or something like that. We don't really know what the costs are 200, 300 years. And of course, we don't know what technology is either, but there are some pretty dark scenarios 200, 300 years out with melting of Greenland ice sheets and so forth. That would be pretty darn difficult. It's one thing to deal with 3 feet of sea level rise. It's another thing to deal with 60 feet of sea level rise. So
I was all with you on innovation and carbon tax. And
possibly. But actually, the main
dispute any of that.
Right. The main point here is that there is actually a metric that we use all the time to assess the cost of climate policies, and that's the social cost of carbon. Now, we don't really know what the social cost of carbon is. We have to be honest about that. There's a lot of uncertainty in a range. I would personally put my main range as 50 to 125. There's reasons to think it could be more than that. There's pretty good studies that look at tipping points that maybe it's more than that. It could be a little less than that, although I don't think so, because an awful lot of stuff is left out of those calculations. Those calculations don't have migration based on, climate stuff. They don't take into account species extinction at all. So there's a whole part of this that isn't just people, it's the world outside John's window there, which is the rest. So hold on one second. If you just take 50 to 125, then as sort of a reasonable range, then something that John said is exactly right, which is this is a great opportunity for economists to do cost benefit analysis and to think carefully. A carbon tax would be great, but we can do things. We do things second best all the time. So we can do second best policies, but they can, they need to be disciplined by cost benefit analysis. I will give you an example, which is on my website from a June 17th presentation this year, which addresses one of the points John raised, which was EVs. The $7.5 billion in the just passed infrastructure, the Senate's passed infrastructure bill, the $1 trillion bill, there's $7.5 billion for charging stations. That's really not very well specified. So I made up some parameters about how they might do that. And I did a cost benefit analysis of that. So what's the cost per ton of that? Turns out that it's like there's a lot of uncertainty. This is based on models in the literature, but it's in the $80 to $100 cost per ton. So it's not cheap. It's not like really low hanging fruit to build those charging stations, but it's not super duper expensive either. It's kind of in the range that I would put the range of the social cost of carbon. So I would say check that box. That seems to be actually a worthwhile policy in terms of cost per ton, but you need to do the work. So I would actually totally underscore that, but it is not nearly as undisciplined or as sort of nugatory as as I think John's critique. There's a lot of detailed work that has to be done, and that's where economists come in. Anil will take over and talk about the monetary policy and regulatory space.
But let me just quickly, I entirely agree with you. And if the policy world were just routinely, I'll give you $200, I'll give you $500 a ton. If we just simply said every step, especially the one the central banks want to do, here is the cost benefit analysis, this would be just dramatically better. And I do want to mention species. I'm really soft about species extinctions, but if that's the question, carbon is not the answer. We're going to shoot the elephants long before that hotter temperature gets rid of them.
I think it's both.
$1 trillion spent buying land and turning it into total nature preserve would be way better for species, way faster than doing what we're now doing with land and gently cooling the climate.
I'm not going to try to defend monetary policy and climate policy, because I think that's pretty out there, and maybe.
But I will. So I'll do that after you, because
Okay.
I will.
I mean, I think, John, it's a red herring to talk about physical risk. That's not where the financial implication will come from. It'll come from your carbon tax that you want to put on. So how do you know that a $50 a ton carbon tax is not going to bankrupt several financial institutions right now? And which ones would they be, and how interconnected would they be? It's just like not understanding that subprime housing was owned disproportionately by banks that were thinly capitalized. Now, they're better capitalized now, but all I was calling for is we need to start figuring this out. And I don't think you've made a very compelling case to say that the official sector can't make progress on this, and it would be pretty valuable. It would certainly pass a cost-benefit test to say it's a good use of their time to design a scenario that's thoughtful, put everybody through the paces, and find out if everybody's going to sell the same stuff, or find out if we actually invoke the carbon tax that it seems like the Europeans and the Biden administration want to invoke. What will happen? I think we have no clue. And I just don't see how you could be against that. I'm not.
It's a great question for the carbon tax and the regulations. If you're going to take the financial system, maybe you should think a bit about how quickly to put on the carbon tax. But that's not what we're talking about. The ECB, our banks are defunding fossil fuels immediately. The ECB is buying up its ideas of green bonds right now. That's not about just figuring out.
John, that's one small part of it. That's one small part of it. There's land that's going to become uninhabitable. There's other industries that are going to.
Oh, wait. Now you're back to weather. Land becoming uninhabitable is 50 years.
No, if the carbon, you don't think financial markets will pull forward the carbon price? I mean, financial markets are all about pulling forward news. If you put in place a credible carbon tax, it's going to change all kinds of relative prices. It may not be uninhabitable, but the price is going to crater.
I think an analysis of the financial effects of a carbon tax is a great idea.
That's the core of the stress test. That is the single biggest input into a stress test. So if you're for carbon taxes, how you would not want to regulate the
output is then you shouldn't invest in oil companies. The output is not, let's see some capital on your books.
Well, you might want to know which firms are going to go bankrupt right away and find out what would happen if they tipped over pretty quickly.
You gave an eloquent speech on how unknowable all of that was because
no, I said for any individual firm. I didn't say the official sector couldn't put together a coherent forecast. I just said it would never be in the interest of any CEO to spend his money or her money doing it. It's exactly why it's a public good.
I think we've come to some points of agreement here, Laura, don't you?
I agree. I was particularly struck, though, John, by your comment about the climate financial regulatory policy being a new fad, since particularly in Europe, it has become, such an important part of the financial markets and the banking system. So how do you see that playing out in the US, or do you think the US is going to just go its own course and be completely different?
So I assume that I'm going to take that as a question for the panel. So I'm going to jump in here ahead of John on that. So first of all, I think the way I see monetary, as I outlined in my initial presentation, I see monetary policy doing climate policy as a second best because the appropriate authorities haven't done it. Monetary policy does have an important role in terms of financial system stability. John and Anil are debating whether or not that's like a big deal or not. If I'm risk averse, I'll go with Anil because I, spend a little bit more economist time and a little bit more resource time, and then we'll find out. So I will go with the disclosures and stress test just out of caution. In terms of monetary policy doing climate policy, I think we are even in Europe, we've had pretty proactive things from the EU, but they have limits in terms of what they're going to be able to do with all of their member states. I think one can argue that in a second best world, there is a potential role for monetary policy doing climate policy. That requires analysis. It requires asking hard questions. It requires quantification. That quantification hasn't been done. It's a terrific research program. There's some papers out there. I saw Monica Piazzesi has a really interesting recent piece on this. I think there's some good research, but it's just in its earliest stages. In the United States, we have a different institutional setting. We are, first of all, much less comfortable than Europe doing real climate policy. So there's more of a role for the central bank. At the same time, there's more institutional restrictions on our central bank doing monetary policy. So I think there's climate policy. So I think I think that's like that's an important question to be discussed. At a minimum, one thing that the central bank can do is address this question that we just don't know enough about climate and the economy. We have some terrific researchers at central banks and terrific young researchers on this call, and learning more about the way that monetary policy and climate policy interact, and climate policy affects financial markets, what the real effects of climate policy and climate change are. I think those are great things to be doing research on, and that seems like a very good role for the central bank.
I'll just make a couple comments here. Europe is, in some sense, farther along on this. They have already passed a Green Deal. They didn't say new, but Green Deal. And the European Central Bank is much more interventionist already than the Fed is, both on defunding fossil fuels and subsidizing green investments. Let's not forget, though, that the US is way ahead of Europe. Jim keeps saying we don't have policy. We reduced CO2 emissions far more than Europe did. Why? Because we allowed fracking and natural gas, which is not great, but it's a whole lot better than coal and oil. Germany is kind of a disaster because they got rid of their nuclear industry and they put solar panels in where the sun don't shine. So now they import coal-fired power from Eastern Europe. I'm a big believer. I worry about this because I think it's going to ruin financial stability considerations. As nobody was paying attention to pandemic, the focus on climate risk as the only risk is leading to financial stability problems. What are the out-of-the-box risks that no one's worrying about with the financial system? Well, maybe that somebody passes a carbon tax, but maybe what happens when China invades Taiwan? What happens when a nuclear weapon goes off in the Middle East? What happens if there's another pandemic that this time kills 10% of the people that infects, which, historically, that's still mild. This was just a wake-up call. No one's paying attention to any of this stuff because they're obsessed with climate. So we need to save financial regulation as well. And it's the problem. You say, what do we do about financial risks, about climate risks, rather than ask the question, what are the out-of-the-box risks? And climate just isn't top on the agenda there, imperiling our financial stability.
Anil, do you have anything?
Well, I'll take the bait on the last thing John said. I mean, you can have the stability of the graveyard. If you want to have no financial crises, you can do it. But it's probably the financial system that'll add much value and will support growth very well.
No, that's not true. Tons and tons of equity. Come on, we've been through this one.
I understand that, but I think some leverage is actually helpful in the financial system, and it's not all evil to have some debt in there. But I don't think it's necessarily advisable to say we want the every tail risk to be covered in all scenarios. I think you got to live with a little bit of risk, and I think you can have a trade-off about that. I'm much more worried about correlated risks that come from things like carbon taxes, where it's the official policy of the US government right now that we're going to raise the price of carbon, and there's very little research on what that might mean.
Anil, do you really think that the US, that our environmental regulators and lawmakers are so incompetent that they would pass a policy that would not just hurt some companies, but that would cause a systemic financial crisis?
John, do you think it would be official government policy to allow 97% loan to value ratio loans?
That was
short term. Cause a financial crisis. I mean, there's all kinds of things that can happen. I don't see it. I mean, I think
companies are not financed by short-term debt and collateralized mortgage obligations.
Sure, but
so stockholders lose some money. People lose money. That's not the end of the world. Stockholders lose some money. Long-term bondholders lose some money. These are already low price to book assets in the first place.
But we don't
That's
know
where
the,
the danger is.
we don't know the exposure of the banking system and the insurance system to big changes in these prices.
We don't know their exposure to Tesla. You know, oil was negative last summer. Oil has always been a risky business. If you want to worry about financial exposures, let's worry about financial exposures to the big.
This is why if you want to do it one relative price at a time, good luck. I think you should have a whole scenario that aggregates this stuff and says, here's a coherent view of how the world might change. Let's see what happens. That's all I'm saying. And it seems hard to disagree with that. I think we just don't know. And
that's not on the table. The SEC's regulations, where the Fed wants to go with climate policy, what's not on the table is Anil Kashyap puts together the grand model and says, well, here's what I think a carbon tax.
It's literally what the Bank of England is doing. They've got a stress test like I described in the field. We can do that here.
You know, John, I find this argument that you're making just really puzzling. I mean, what you're saying is that, you know, here's a suggestion, not an implausible suggestion for doing stress tests, certainly a reasonable suggestion. And your argument is, I'd rather have a different stress test. I don't see how that addresses the question. Maybe we should have both stress tests. We should have what Anil is suggesting, and we should have the, you know, much more virulent version of SARS-CoV-3, you know. That's not an unreasonable suggestion either, and then we should figure out how to do that. But this is what's on the table. So I guess I find it puzzling just to argue against a good idea by saying that you have a better idea that's irrelevant.
What's on the table, what's going on is, bank, you're lending to fossil fuel companies. That doesn't look too good. Maybe should we send some regulators down there and see what's in trouble? If it were an honest stress test of the out-of-the-box risks, trying to understand what's going on with the banking system, trying to see what would be the effects of explicit carbon tax, I'd be all for it, but that's not what's going on.
That is what other countries are doing, John. The Bank of France just did one. The Bank of England's doing one. I mean, maybe we can't learn from other countries, but I think we
for one, you're asking for a system-wide investigation, which makes a lot of sense. Understand what it is, not a bank by bank. Let's look at your assets and see.
Right. Exactly. And I mean, and this gets to a broader point. I mean, let's go back to your disclosure and these ESG scores. I agree that they're a mess right now, but if you wanted to think about what would be a good environmental score, you would have to know something about how in, you know, the scenario where the world's warming and all kinds of things are changing, what is this business's response going to be, and what's their contribution to all of that? So I think a lot of this is interconnected of trying to imagine a world where we go down this path with, you know, kind of business as usual or something close to that. Things start moving, and then you get a policy response. I don't think we're going to get to the state of the world where we literally see the sea rising as triggering all this. It'll be the response. It'll be the response of the policy that I think will trigger something quickly. There's plenty
I'm sorry. I didn't mean to interrupt. I thought you were done.
Well, I would just say
no. I am going to interrupt John. I'd like to change the topic for a second.
Let me just find a little agreement first, Jim. I think Neil and I can agree that if the danger is that climate policy might be so boneheaded as to destroy the financial system, we ought to know about that. Now, Jim, please change the topic.
So actually, I'm really curious. I don't know a lot about ESG, but it strikes me as an opportunity for, like, a lot of problems, a lot of greenwashing, a lot of feeling good, but without a lot of evidence that we've actually doing something to change corporate behavior. There are people who really would like to spend their money, I would, invested in a way that would induce corporations to have responsible, forward-looking policies. Laura, you've spent a lot of time thinking about ESG. Anil, I'd be interested in your views, but I guess maybe especially Laura, because you actually know something about this, and I don't know anything about this. But it seems to me like there's a lot of challenges. Like, what are the researchable questions to improve that system?
And what are the documentable, not just, we have a feel-good policy here.
Well, I think the biggest problem with ESG is that people don't agree on what it means. And so there are those who view investing according to environmental, social, and governance issues as being based on taste and preferences, the old socially responsible investing, versus those that believe their return opportunities and in particular that they're going to be risk mitigation by looking at how companies treat these issues. And I think that's where a lot of problems come from. And also, while we don't know whether investing this way improves or doesn't the performance of a firm. So I think, and I was going to ask this question about, the banks, they may have regulators putting pressure on them in terms of who they're loaning to, but more than any regulators, they have their big investors are putting pressure on them. And so how should we think about this Wall Street versus Main Street? Or I guess this is all kind of Wall Street and banks, but how should we think about the pressure that investors are ultimately putting? And this can ultimately come back to the retail investors who are deciding where they want their money to go.
So there's an issue here, Laura, I'd like to learn more about. As I'm a free marketer, so if people want to invest their money in green stuff, well, fine. If they want to defund fossil fuels out of their portfolio, you can't argue with that. But there is a big agency conflict here. I just found out, for example, my money's in Vanguard, their total market portfolio. They're outsourcing how they vote their shares. And so they're voting their shares for all sorts of green and virtue signaling things that I don't agree with. So it doesn't seem to be the situation that well-informed ultimate investors are pushing here, but rather that small numbers of activist investors are able to push at board meetings, that the ISS and the share voting systems are able to be hijacked, or that small groups can exert a lot of pressure that the ultimate investors aren't necessarily that interested in.
Sean, you can take your money out of Vanguard and invest it in individual stocks and vote the way you want.
That's a big pain in the butt.
But that's a free market solution for you.
Transactions costs matter, even to free market economists.
Most of the large asset managers have signed on to these objectives. I mean, just as a matter of course, there's something like 90 of them that control huge swaths of the assets under management have signed up to short Cochrane's views. I think the line I've taken in the little work I've done on this is to say that benchmarks are better than scores, and that if you actually provide benchmarks, now you still have to decide what gets into the benchmark. So this is not a freebie, but if you do that, you get two benefits of that. First of all, it generates kind of like the S&P 500 inclusion thing. You get a boost to your share price from being in that benchmark, and it induces a penalty on the people that are out of favor of the benchmark. So I think that's a cleaner way to go if you can to try to push these things, rather than the way that's done in practice now, which is take these averages of the scores. I agree with everything Laura said about how little we know about all of this, and whether or not the asset managers are all talk and no action, even whether they're really gonna, when it comes down to it, if they've got a benchmark like the S&P 500, and yet they're lifting their leg on a bunch of the components, are they going to tolerate the tracking error, or what are they going to do? The one possibility is they just vote out the current directors of all the firms, and they don't do anything more than that, and hope that the new directors will move in the direction they want. But I'm not sure that's as powerful as just saying I'm willing to not hold the firm and tolerate the tracking error. I don't know, Laura, if you've got a view on that, I'd be curious.
Well, there seems to be diverse approaches by the institutional investors, because some of them will divest, not hold those firms, avoid those firms, but a lot more of them believe that engagement is the better approach, where they try to get the firm to change rather than just avoiding the firm. And I think this also brings up, so Tom Gilligan has a question that he's asked that I think is directly related to this. And he said, and Tom Gilligan used to be dean of our school. He used to be head of the Hoover Institute, where John is. So, and he has strong beliefs in my experience. But his question is, Exxon had a contentious proxy contest earlier this year in which an investment firm installed new directors to hasten Exxon's transition away from fossil fuels. Does Anil or any of the other panelists have a view on the transitional risk associated with this private approach to climate change, which is really what we've been talking about?
I mean, I think that's a good point. I mean, another example of this would say, suppose the public just wakes up and decides they don't want to buy, internal combustion engines and just votes with their feet. What would happen? I think these behavioral responses, either through the channel he just described, or because the public just becomes fearful of doing certain things, could have very, very big effects. I think that's one of the things you'd learn about in one of these stress tests. And I think until we've got that first round of what's, who wins and who loses and what's the exposure, it's hard to go much further to know how big a risk this is. But, I think it was completely appropriate for these people to put pressure on Exxon. Exxon tried to make its case. That seems to me to be a fine thing to be going on. It's just, we can't predict whether or not this is going to accelerate quickly. And that's something I'm pretty worried about.
Let me just make a comment on this. I want to frame this for the PhD students who might not be aware that the issue here. I'd say, investors want to invest in green stuff. And if it's real green or virtue signaling green, who cares? It's their money. Why are we arguing about whether it does or doesn't cost money? Well, here's the fundamental problem. An asset manager is legally required to invest money with one goal only, namely to maximize return on investment. An asset manager is not allowed to say, well, I'm going to put money here, especially delegating. So you're a pension fund, you collect money from people, you invest that money with an asset manager. It's sort of like the climate risk business. They want to do things they're not allowed to do, so we have to pretend that it earns more money. Now, the fact is, deciding which investments get higher returns than others is a very difficult business. Returns are very volatile. Sigma over root T makes this a hard problem. And then correcting. If you put your money in an ESG portfolio now, where it's going to be is in big tech companies because they don't emit a lot of carbon. It's not going to be in oil and stuff like that. Well, those are also the value stocks, and the big tech companies are the growth stocks. So you have when you rotate into ESG, you have to decide this alpha question. You have to correct for the 100 other value and the 100 other styles that we have in here that you're implicitly exposing yourself to. So it's very hard to tell that any style, including ESG, generates more or less alpha. Why do we care about this issue? We care because of this legal restriction on delegated managers making up, deciding, what's virtuous and what's not virtuous. And also, Exxon, it's puzzling to me that you want to force Exxon to become a green company. Exxon has what you want is the world to become green. You want new companies to come in and provide green power. Exxon has no expertise whatsoever in managing solar panels. And the history of innovation is that old companies are terrible at this stuff. The word processor was not invented by typewriter companies. The digital camera was not invented by Kodak. Well, it was invented by Kodak, but they blew it on the way. So the idea that each individual company should become green seems that's just not in the history of technological transitions how you do this thing effectively.
I agree with that, John, but if the buggy whip companies had enough money to lobby against cars, you probably wouldn't have worked out as well. And that's part of what it's about.
Couldn't agree more with what Anil just said, which is, but then I would say on top of that, it's not quite as obvious that that's the case. So there are certain aspects of a future green economy that might transpire having to do with, for example, green hydrogen, and with carbon capture and storage, and with advanced sustainable aviation fuels, where actually a lot of the technical skills that refiners, not necessarily the petroleum producers, but mining also, and drilling also have, they have technical skills and know-how that might turn out to be useful. And actually one of the most interesting developments in the fuel scene right now is that a number of traditional, over just the past few years, a number of refiners are realizing that declining demand, the writing is on the wall, and they're switching over to doing things like using their existing facilities for green aviation fuels. That's just a beginning drop in the bucket, but there actually are roles for a lot of these technologies and the technological expertise that these companies have.
No, and this is a great point. Also, with the current enthusiasms, carbon capture and storage or hydrogen would upend the whole business we're into now of subsidizing windmills and electric cars. I know something about aviation fuels. That's another case where the whole reason we don't have that now is because FAA regulation makes it so impossible to innovate the whole aircraft industry.
Okay, so we haven't spent time yet talking about disclosure of ESG issues, including climate. And Russ Wormers has a question, which is that Pastor Stanbon Taylor make a good point that if a high enough proportion of investors value ESG, then it becomes a price factor. So if so, shouldn't the SEC at least attempt to push forward with disclosure standards for corporations and investment funds?
I completely endorse what Russ just said. The question though is how do you, it goes back to the thing you were saying, Laura, which is how do you know what is actually environmentally friendly? And John said something about holding them accountable if they just blabber and in fact aren't walking the walk. But I think that's a key ingredient, and forcing everybody to do it on a common template so that you can't say I cherry picked my score and it's good this way and Jim did his and John did his, I think is critical. So that's something where I think the official sector could do a much better job of saying we're not going to tolerate all this self-serving feel-good disclosure. We're going to actually hold you accountable to some stuff. And I think that would be an accelerant to move in the direction we want.
This is a PhD student symposium, so I'll highlight this as a place for research because there's a great tension here. I regard most of this stuff as completely unknowable. If you've tried to do a personal, what's my carbon footprint calculation, you'll find how incredibly hard it is, especially how far down are you going to go? Are you going to say, how much carbon do we emit? How much carbon do we and all the people we buy from emit? How much carbon do we and all the people we sell to emit? These calculations are essentially unknowable, which is the central part of the problem. Now, one approach says, look, this is about information. And so the right answer here is not one government-run standard. I mean, we went through this with organic foods, what counts as natural or whatever. And just this one tiny slice of how hard this one's going to be. So one perfectly reasonable argument, this is a job for private sector certification, a underwriter's labs, which will go in and say, yes, I certify that your claims mean something. Another view is, look, what people want is feel good, so let them buy the feel good stuff, even if it is just marketing, branding, and puffery. Well, people seem to want marketing, branding, and puffery and don't demand certified stuff. Well, let them have what they want. The other part is, there's a lot of tradition in our system for anti-fraud, and that your marketing claims have to bear up. And that's, I'm a little sympathetic to disclosure because I think most of this stuff is completely empty. And if you were forced to disclose under criminal penalties your calculations, the whole business would just evaporate instantly and people would not stop making these claims. So you can see I'm of many minds here, but I think that highlights this whole question as a great research topic in the larger part of, do we demand independent verification of marketing claims? Do we demand regulatory standards, which then become ossified and out of date the minute they're put in for marketing claims? What kind of penalties should there be? That's a great research question.
Well, and speaking of research questions, do you, since this is PhD students, do you have suggestions on these topics for more research questions? If you were a PhD student and you had a passion for these topics, which area would you point them toward?
I go with what John just said, ESG with teeth, something that actually, consequential ways to measure true environmental impact, and then you know, whether or not some private sector company could come up with it, or it's licensed through the government or whatever, FDA type thing, I don't know. But I think trying to get to the bottom of what actually we mean by something that's environmentally friendly or sustainable, whatever you're going to call it, I think is a first order thing. And that would be a long research program. You probably have to learn some science but there's a long history of intellectual arbitrage of where you learn something here, you bring some economics and you push the discipline forward. I think that's a good area.
Jim, you want to say something or?
Yeah, sure. I think that, you know, Laura, you raised the confusion about what ESG is all about. And I guess I would say on this, I guess this was the second of your points, is there any, what is the real side effect of ESG designation? Do we actually see a company that might want to do ESG is therefore incentivized to do certain classes of investments or buildings or whatever that it would not otherwise be? I mean, that's what we, you know, as an active, that would be one aspect of activist investment. I'd be really anything that links these financial market things to real side effects in the climate emissions space. I think that's a really interesting question, and very little work on that.
I would offer a slightly meta advice by the way you framed it. If you're doing something because you have passion for the question, watch out. That suggests that you already have the answers in mind. You want to force companies to stand up and do the right thing for the climate, or you want to, you know, figure out how to implement the Green New Deal. Passion for answers and passion to change the world is a wonderful thing, but it's not the way to produce great research. Great research comes out of skepticism. It comes out of taking the answers that make everybody around you feel good and say, wait a minute, what are the, let's do it the other way around, not find questions to which this is a good answer. Let's find out what is the real question, what are the answers to those questions, and at every step of the way, be skeptical of everything you're told by anyone older than you.
Well, actually, I meant passion toward the research in these areas more than passion toward wanting the world to turn green.
Well, I knew exactly what you meant, but many people are not passionate about skeptically, everything around me is wrong, what's right. They're passionate about joining this great social and moral crusade. And that's a fine thing for other things, but that's not a way to produce useful economic research.
So one more thing about ESG, and this relates to a question we've gotten from Crystal Yenting Shi, and she says, Judge Leo Strine advocates to put employees ahead of ESG and make it ESG. Do you think employees should be separated from S and prioritized in sustainability? Why or why not? And I'd like to make that a broader question of, should we be talking about ESG as one big lump of something, you know, all smushed together? Or should we be looking at these different activities by companies as separate issues?
I'm so glad you asked that. One of the great things that is hurting our valiant attempts to fix the climate is that it got wrapped up in a whole bunch of progressive social and other cultural issues. And if it's not just environmental, but also social, and what are your practices towards your workers, and do you hire enough union people, and have you signed on to every other part of a particular political agenda? That really hurt. That is why we don't have, Jim said, why do we not have climate now? Because it got wrapped up in one very partisan political agenda and didn't become, the way we have been discussing it, a technocratic, apolitical thing. So if you wrap up environment along with your labor practices and and which party you vote for, basically, you're not going to get the environment stuff you want out of it either.
I guess a different way to think about this is where Jim started was, I think, exactly appropriate. He said, what are the externalities here? And for some of these things, there's clear externalities. For others, it's, as John said, it's advocacy or just some, you could try to make the case that all parts of E, S, and G involve some form of externality, but I think they should each have to stand on their own. And it's not even obvious that they're also interlinked. I mean, there are lots of critiques of you know, so corporate activism gone amiss. I was guessing John was going to go off on Milton Friedman's dictum about what the role of a corporation should be, and whether or not
I only didn't have a lack of time, but I'll put it, to fix the climate, we want to have Republicans willing to go along with fixing the climate. And if you make them swallow everything that they don't believe in on other issues in order to fix the climate, we're not going to fix the climate.
So what I would disagree with is that if the F-150 is cheaper than the ICE F-150, then we don't need to worry about what John just said. So it's on us to see that that happens.
And
Yeah,
just
we-
make
we-
sure that
and
everybody
you don't-
understands you're talking about if the electric Ford truck F-150 is cheaper than the gas-powered Ford
And if-
truck F-150.
If it's all life cycle, carbon is actually lower than the gas one, which we have to make sure is true. Once you make the batteries, get rid of the batteries, make the power for it, and so forth, which it is true, but that's an important part of it. But Jim's exactly right.
That's a false argument. And that's a false argument that is used by the climate deniers in the short run, because at the moment we have a dirty power sector. So cleaning up the transportation sector and cleaning up the power sector have to go hand in hand. And we need to have more environmentally sensitive batteries and ways to process lithium and so forth. And that work is ongoing. It is a false argument to think about changing one of those, but not changing the system.
You're exactly right, but we have to measure the entire system and verify that it is. But Jim's point was so deep. If you do that, then you don't have to have political leaning on companies to do stuff through all these other mechanisms. It'll just happen on its own. And you don't have to have a trade-off between economic growth and green. Then you get both of them. So that's innovation and adaptation are the economic answer.
I agree with what you just said, John, but I mean, I think the key thing here is getting the right social price of carbon into the equation, recognizing that the incumbents have a strong political economy reason to fight like crazy to prevent it. And that's where a lot of this disagreement comes. If we could use the price system, all the better, but we shouldn't pretend that the price system just takes care of itself and there aren't vested interests that are going to try to undermine this.
Well, come on, it's not just evil vested interests. What did this headline come from? The headline came from the fact that we live in a democratic society. And if our president says the price of gas is going to be $10 a gallon, he's not going to be president very long. And that's not evil vested interest of the oil companies. That's the fact of we got to make one thing cheaper, not just make the other thing more expensive.
Fair point.
Okay, so we have run out of time. I want to give you each like 1 minute to give some advice to the PhD students. And my advice would be, it's just a great career doing the research. You get to change and you find out so much by doing the research. So, and just look for something that will be interesting, but that other people will also be interested in. So that's my bit of advice.
So I'm going to agree with John in the research advice, which is that it's important to be passionate about what you're looking at. So maybe that's financial markets, maybe that's climate, maybe that's something else in this space. But you have to be dispassionate about what the results are going to be. You know, the right way to say that is we have a job to do in terms of decarbonizing the economy as effectively and efficiently as possible. And so being a good scientist is the way to help make that happen.
I mean, here's a more concrete thing. A lot of these other central banks and regulators have done the kinds of stress tests I've talked about. Go look at the results and find out where they botched it and think about how you could do it better. And you know, what's the next step forward there? That's a way to get something that's actionable. I don't know that it's going to land in the AER or the Journal of Finance right away, but it'll bring you up to the frontier of what the challenges are. And it'll give you a way to see around the corner as to where some of these issues are going to be. And I think there's a lot of improvement that could be made.
Well, it's this is a good field and that you want to be in a field that lots of other people are working on. You're not all alone. Research comes from bouncing ideas off of other people. Frankly, it's good to be in a field where places are hiring and there is money. But be aware, you are stepping here into a political minefield. In today's academic environment, it is very dangerous to come up with the wrong answers on climate. It would be hard to get research money if you come up with the wrong answers. It'll be hard to get jobs. It'll be hard to get promotions. Race and gender is probably worse in the difficulty of doing this kind of research. But you're going into a very politicized environment where it will be hard to do what we have done here and have a technocratic, dispassionate argument about costs and benefits.
Thank all three of you, John, Anil, and Jim. I really appreciate so much your coming and being part of this conversation. I learned a lot from it. I'm sure everybody else did too.
Thanks very much. Thanks very much.
Laura.
Thank you.
And Scott has pointed out that it starts tomorrow at 10 a.m. So see you then.